Hi YouTube, welcome back. So today we're going to go through the earnings report of one of the biggest and most famous companies in the world, known as Berkshire Hathaway Incorporated. So if you're not aware, Berkshire Hathaway is the holding company of the world's most famous value investor, Warren Buffett. So he set this up many years ago, and it has grown into a conglomerate and a giant in the world. So today we're going to go through how to read a quarterly report from Berkshire Hathaway. So we always the forms are usually labeled as Form 10Q. So these are the quarterly reports. I also have another quarterly report of Amazon here, but I don't think we have time to go through both in one video. So I'll probably be doing Amazon in another video. What is a quarterly report? It's generally a very long-winded, detailed financial report, and you can look through. These are like 56 pages of numbers and text. Most of the time, people just won't have time to go through everything, so it's quite daunting. But thankfully, Berkshire Hathaway is one of the companies that gives the cleanest reports, as Warren Buffett himself is a big advocate on value investing and of numbers, especially in reports, to make sure that reports are clean and easy to read. So this is one of the best corporate reports to read. So probably I'll be doing some other videos on other companies' reports to show you the difference. First, let's get right to it. As we go through financial reports, you can come to this contents page where you see blue hyperlinks. Hence, everything already has a link to the relevant pages, which makes our life a lot easier for the person that's reading the report. First and foremost, we probably want to read through the earnings revenue. Okay, so simply click on, let me just demonstrate this again. So you mouse over consolidated statements of earnings. In this case will be the third quarter or the first 9 months of 2019 and 2018. Click on it. You will instantly be teleported to this page. And what we want to see here is net earnings to Berkshire Hathaway stockholders. Scroll a bit upwards, you can see this is for the first 9 months of 2018 and 2019. Coming back down here, we can see that for 2019 is 52,258. And if you scroll up, it says here dollars in millions except per share amounts. Hence, to put this into perspective, this is $52 billion in just the first 3 quarters of 2019, compared to $29 billion in the first 3 quarters of 2018. So when you're dealing with reading through the reports of big companies like Berkshire Hathaway or Amazon, the numbers are usually in billions. So you gotta get used to it. Some people might be really shell-shocked that they probably never see this money in their whole lives. I'll probably never see this much money in my whole life, in my own bank account at least. But yeah, it's billions of dollars. So this is $52 billion. So this is pretty good. It's a pretty good sign. It means that for 2019, it's quite a big growth, almost doubled the growth. So when you want to look at the breakdown of how we get to this 52 billion, you can actually scroll up. So you want to see what is the total revenue. Hence, for Berkshire Hathaway, they split their conglomerate into 2 general businesses. One is insurance and other. Another one is railroad, utilities, and energy. And we can see total revenues of 189 billion for 2019, first 3 quarters, compared with 184 billion. So there is a growth in revenue. And let's take a look at which is the biggest growth engine. Seems like for railroad, not much difference there, 32 billion for each 3 quarters. So it seems like the growth is mainly from insurance and others. 156 billion 2019 versus 151 billion for 2018. So our main growth is there. Then let's look at the costs. So we gotta see if the increase in revenue comes at a price of increase in costs. For 2019, there's a total cost of 165 billion compared with 2018, 161 billion. So there's a rise in cost of about $4 billion. Not too great, obviously there's a rise in cost. So let's take a look at insurance costs. There's a rise in about 4 billion, whereby for railroad, the cost stayed about the same. So with increase in revenue from the insurance and other business comes increase in cost as well. So the increase in revenue and the increase in costs are quite balanced out. You might wonder, how then did we get to this net earnings of 52 billion compared to 29 billion? This is where you have to look in further detail for the rows that are below this interest expense. Berkshire Hathaway. Okay. Let's try to find. Found it. So it's in this small rows here. Investment and derivative gain. Investment gains of $40 billion for first three quarters of 2019, compared to just 12 billion in first three quarters of 2018, and derivative contract gains of 1.2 billion compared to just 303 million in 2018. So 1.2 billion from derivative contract gains in first three quarters 2019. So this made the total investment gain of 41 billion for 2019 compared to just 13 billion for 2018. So this is the main driver. The main driver here seems to be the net revenue driver. The growth in the revenue, seems to be from the growth in the investment gains for this year. Okay, so this is where revenue. So all in all, seems pretty good. It seems to be a good sign. However, you have to take note that the increase in revenue doesn't really come from increase in revenue from their business, because they balance the increase in revenue of the insurance business by increase in the cost of the insurance business as well. And mainly the gain in revenue for this year comes from investment gains, probably due to the stock market running, the bullish stock market in general, and the investments of Berkshire Hathaway being bearing fruit and paying out. So let's go back to the contents page. So that will be their earnings. Then let's look at comprehensive income. Okay, let's see whether we can find assets. I believe it should be this consolidated balance sheet. All right. So after looking at earnings, we want to look at assets of the company. Generally, in terms of value investing, a company that is growing should have growing assets. But of course, total assets are broken down into two separate components. One is shareholder equity and one is total liabilities. Obviously, if your total liabilities grow, that means most of your debt grows. It could also lead to a growth in your assets, but you wouldn't really want your growth to be fueled by growing liabilities, because you just owe people more and more money. Probably you'll want to see the positive growth in your shareholder equity. That will be the best way for a company to grow. Best way for the total assets to grow as well. So let's compare total assets. Should be labeled here. In December 31st of 2018, total assets was at $707 billion, compared to just September 30th of 2019, the first 3 quarters of this year, is already at 788 billion. So there's a growth of about 80 billion for assets, which seems to be quite good. So now let's break it down for these assets. Whether is it a growth in liabilities or whether is it a growth in shareholder equity. Let's take a look. So as of December last year, shareholder equity was 348 billion. But as of September 30th this year, shareholder equity is at, oh sorry, okay, let's look at this total shareholder equity. So 352 billion in December last year compared to 401 billion in September this year. So there is a growth of about almost $50 billion in shareholder equity. Okay, then let's look at liabilities. So total liability seems to have grown a little bit as well. 300, okay, billions of dollars is not a little bit. So as of last year, December, it was 355 billion in total liabilities compared to 386 billion in September this year. So liabilities have grown about approximately 30 billion, but shareholder equity has grown by about 50 billion. So that's not too bad. That means there's more growth in shareholder equity as compared to growth in total liabilities. So combined together, that makes it a growth of $80 billion growth in total assets. Alright, so the important things of assets are done, revenue is done. Let's look at cash flow. So you can see this from here, consolidated statements of cash flow. So you click and you get teleported to here. So let's look at, scroll up. First 9 months, 2018 and 2019. You can see total cash. In 2018, it was $42 billion in total cash compared to 2019 of $75 billion. So pretty good sign. Obviously, if you're a value investor, you want to invest in companies that have a lot of cash flow. That means positive cash flow, meaning they got cash in their bank, cash in their account. Obviously, you can grow a company by borrowing money, taking up loans, and you can grow based on negative cash flow, but that's very risky because, for example, if you don't have the cash flow to pay the bank can come in and declare your company as bankrupt and try to claim anything that they can, so will lead to a collapse of the company. So obviously, having positive cash flow in the account of the companies are very important. So we have a growth in the cash for this year, which is good, and we can look at the breakdown of how we get to this growth in cash. So beginning of the year seems to be quite similar, 32 billion beginning of the year for 2018, or 30 billion beginning of the year for 2019. And so 30 billion. Okay, cash and cash equivalent 75. Third quarter. So beginning of the year is here. So the increase is 44 billion for this year, whereby the increase for 2018 is only 9 billion. And let's look at a further breakdown of how we get to the increase of 44 billion. So we can scroll up. So from operating activities, that means from the day-to-day activities of running the companies. Last year was 26 billion. This year is same, 26 billion. So no difference from operating activities. Let's look at investing. Okay, investing, we already see the difference. Last year it has negative 11 billion in investing cash flow. So when you see numbers that are in brackets, it means negative. So the company paid 11 billion to invest in probably other companies or other shares and so on, whereby this year Berkshire Hathaway actually gained from the investing activities. They gained a total of 15 billion from investing activities in terms of cash. And let's look at financing activities. That means borrowing from insurance, loans and so on, short-term borrowings and so on. Okay, let's net cash from financing activities. So last year it had a negative 5 billion of net cash flow. That means it paid 5 billion for financing activities. But this year it gained 2.5 billion from financing activities. So if you add up these three, for example, the net cash flow from operating, net cash flow from investing activities, net cash flow from operating, you add it together with net cash flow from investing activities, and you add up the net cash flow from financing activities, you will get your total increase in cash flow. So that's how for this year Berkshire Hathaway had such a big gain in cash flow mainly from their investing activities and also from their financing activities, because their operating activities didn't give them any increase in cash flow. While in the beginning of the year, their cash amount is about the same. So all in all, those are the three main things that you want to see from a balance report. So let's summarize. You want to look at the assets, which you can go to the consolidated balance sheet to look at whether the company is growing their assets. After which, you will want to look at their earnings. So you can see consolidated statements of earnings to see if the company is growing in earnings. And the third one would be their cash flow to see whether the company has any positive cash flow in their bank accounts or are they running purely on debt. So those are the three main things. And since we're on the topic of earnings, so there's a very popular metric, which is the price to earnings ratio. You can't really see price to earnings ratio in an earnings report. That's because the share price is something that is dynamic and it fluctuates every single day. However, the net earnings per share, so there's $21.30 per Class B share, because this is not in millions. You can use this value to calculate the price to earnings ratio. So all we need to do is just to go to Google the latest share price. So so maybe I just type Berkshire Hathaway share price. Okay, so let's Google that. So this is Class A share price, and let's look at Class B share price. So it's $226.31. Then we have to take a calculator. So let's round it down to $226 per share, and take a look at, so for this year, first 9 months 2019 is $21.30 per share. So let's 226 we divide by 21 and 30 cents. So that gives us a price to earnings ratio of 10.6. For Berkshire Hathaway, 10.6 is a pretty good value actually, because if you look at the share price after the recent bull run, Berkshire Hathaway share price is currently at an all-time high for Class B shares at $226.31 per share. So at this all-time high share price, its price to earnings is still at a relatively low value of 10.6. So that's a pretty good value for price to earnings ratio. Of course, you have to take into account that it seems like most of the growth in revenue for Berkshire Hathaway this year seems to be from their investing activities rather than from their growth in their business. So their insurance business might have earned more money this year, but it comes at the expense of increased costs. So most of their rise in their earnings per share actually came from the increase in earnings from their investment side, probably due to the very big bull run. That means the stock price everywhere in US has gone up, so that probably contributed to their main growth from their investing income. So you have to take the growth of Berkshire Hathaway this time with a little bit grain of salt, because what if the stock market crashes? So if the stock market crashes, they'll probably get maybe a negative or maybe not so much earnings from their investment activities. So if they don't get that, then their earnings per share will probably go down, because the main driver of their growth in the earnings per share was due to their earnings from their investing. So whether to invest in Berkshire Hathaway at this point of time will probably be a no for me, because the share price already at an all-time high, and it doesn't seem like their business sides have grown. So all this growth is just due to the bullish stock market. But if the stock market does crashes and it goes down, Berkshire Hathaway will be a very good buy, because their business is very solid. Okay, so that's been a pretty long video again from me. So thanks for watching Simple Invest, and we will see you next time.